everyone, and thank you so much for joining us for today's Cherry Bekaert webinar on pass-through entity election updates. My name is Madeline Robbins, and I am our technical producer at Cherry Bekaert. We have a great presentation planned for you, and we'll be offering up 1 hour of CPE for this session. Now, before we get started, let's go ahead and take a look at the CPE requirements for this session. To receive CPE, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued later on, and after 10 days, if you have not received one, please email cbhlearning@cbh.com. A recorded version of this webinar is also going to be available in about a week. It'll be sent via email and posted to our website. Now, if you have any questions during the webinar, there is a Q&A box down at the bottom control panel on your screen. Please type those questions into the box, and whatever we have time for, we'll be able to provide some answers. A short survey will also be posted at the conclusion of the webinar. We value your feedback and just ask that you take part. And with that, I am happy to introduce our 2 speakers today, Kathy Stanton, leader in Cherry Bekaert's state and local tax practice, along with Tony Kunkel, attorney within Cherry Bekaert's state and local tax practice. Please, Kathy, take it away.
Thank you, Maddie. We could go to the agenda slide. Great. Well, welcome everybody. Hopefully everyone will be really excited about this topic because there is a chance to save some money, and people generally like that when we can do that. But the agenda today, we are going to start off with just the pass-through entity tax election, some background and general mechanics. Then we're going to address some specific pass-through entity tax election examples. Then we're going to look at where are we now in 2022. There's been a lot of activity. We'll get you caught up with that. And then we will look at some specific states and how they handle their elections. We'll have summaries of those states and we'll compare a couple of those. And then we'll also address some special issues and other considerations. And Maddie, I'm not seeing my picture on the screen. Hopefully everyone else is seeing me, or not sure if you can correct that. But you could go to the next slide. Okay, we're going to start with a polling question. We have to have polling questions for you to get CPE. So our first polling question: have you discussed your PTE tax elections eligibility with your tax provider? So we have 3 answers, and I did see a chat that people can see me, so good. I'm glad to hear that. And the first answer is yes, we've already discussed, we're taking advantage of the pass-through entity elections, or we're thinking about them. The second is no, our tax provider has not yet brought them to our attention. Believe me, tax providers are really, really busy these days, so I don't fault anybody. And then the third is just not applicable to our business currently, but I just wanted to learn more about the topic. So if you can just check one of those for CPE. And we have to give you a minute or so for CPE requirements to answer. And let me see if there are any. Okay, so we have the polling. Yes, so a lot of people, yes, 37%. Almost equal number, not applicable currently, but want to hear more. I'll be interested to know whether some of those people say, wow, this is kind of applicable. And then it's pretty, almost evenly split, and people are here just to learn about it as well. So good, well, welcome. I hope that you are ready to learn all about pass-through entity tax elections. So we can go to the next slide and we'll talk about just some of the background. The Tax Cuts and Jobs Act at the federal level, as most of you, I'm sure all of you are aware, if you've watched the news as well, there's been a lot of talk about the SALT cap, state and local tax cap. So at the federal level, a limitation was imposed on the ability to deduct state taxes to the maximum amount of $10,000. So previously, if you had a pass-through entity that was very profitable, might be paying a few $1,000,000 in state taxes if they're doing very well, those taxes were always deductible on the individual return because the income flows through, the deduction flows through as well. Well, this change in the Tax Cut and Jobs Act eliminated the ability to deduct those income taxes, and now you can only deduct $10,000. So we have some significant disparity between being a C corporation and a pass-through entity. At a C corporation level, they can deduct all their state income taxes for federal tax purposes to reduce their federal tax, but for pass-through entities owned by individuals, they can't. We've not had a significant disparity like that in the on the state and local tax side in quite a while, so or ever maybe, but there is definitely distinct difference there. And so initially, all kinds of workarounds were looked at, which we'll look at next. But before that, so the Tax Cut and Jobs Act put this limitation in place, very politically controversial. The IRS on November 9th, 2020, actually issued a notice pretty much saying, hey, we think this pass-through entity tax election methodology works. If you think about it, there are many states, or maybe not many, but at least a handful of states that tax pass-through entities at the entity level. Tennessee is one. It imposes tax on the excise tax on partnerships and S corps. DC unincorporated business tax imposes tax at the entity level. And because those taxes were imposed at the entity level, they've always been deductible for federal tax purposes. So the IRS, in line with that reasoning, I believe, came up with this notice and said, hey, we think, if the tax is imposed at the entity level, it would make the state income tax deductible if it's the entity that's liable for it as opposed to the individual. Regulations should have been issued or were announced that they would be issued, but as of this month, no proposed regulations have come forth. It's questionable whether we will ever see proposed regulations, but I will say it's questionable. The IRS can come back and have some differences in this view, but that's where we stand right now. We can go to the next slide. So a couple of the earlier developments, just for way of background, you may have remembered the charitable contribution workaround, where the state said, we are going to set up this fund, and if you make a contribution to this fund, you can get a credit for that contribution on your tax return. So that contribution will be made, the individual can get a credit. And then where you got the federal deduction, instead of a state income tax deduction, it would be a charitable contribution deduction. The IRS shut that one down pretty quickly because there is a quid pro quo. You were actually getting a benefit, you're getting a credit, so you can't get a charitable contribution deduction for that payment. There is an exception in the C Corp world if it's for a business purpose. But that was, that was actually unfortunate as well, because there were a lot of states that used this type of program to fund their education. And now it kind of caused into question whether they could even use these types of structures to fund their education anymore and give tax credits for them. The second one that really didn't take off at all, the payroll tax. New York had implemented an election to pay a payroll tax instead. And then that would be imposed at the entity level and you would get a credit. But with that payroll tax, it actually ended up still costing the entity a little bit more and just didn't get any buy-in or a lot of elections for that tax. And then the third was before the ability to elect a pass-through entity tax was a mandatory. So similar to Tennessee and DC, where it's mandatory, the income tax is going to be imposed at the pass-through entity level. Connecticut passed legislation that we're going to have mandatory pass-through entity tax at the entity level. And so that was mandatory. And today, that is still really the only kind of mandatory pass-through entity tax, except for those others that had been in existence long-term. So next slide. So how does a pass-through entity tax election work? We probably have a lot of different backgrounds that are watching this webinar. You may not have significant tax background, and then we may have actually some tax practitioners with a lot of tax background. But mechanically, this is generally the way it works. So if I have an S corporation or an LLC, for federal tax purposes, all the income that gets reported on that flow-through entity return gets actually recorded on my individual return. So no federal income tax at the entity level, all gets put on my tax return. So same thing, the states, the majority of states would follow that. Everything flows through the owner, whether they're a resident or a non-resident with income from sources in the state, has to file a resident or a non-resident return and pay the tax. By making an election, which simply can be just a box on a form that you check, like Maryland, for example, comes to mind, Form 411 looks very similar to the Form 410, and it's a box you just check that I'm making this election that I want the tax imposed at the entity level. What that does is, instead of the flow through of income, the entity itself is subject to that tax. And then the first method, there's one of two methods. The first method is the credit method. So that individual that still has that income flowing through to them on their federal return and thereby flowing into their state income tax return, they would get a credit for the tax paid at the entity level. So in Maryland, I would still get a Maryland K-1. I would still get that income. That's still my income. So none of that changes, but the tax was imposed at the entity level. And now I can take my share of that tax and take a credit on my individual tax return. So I generally still have to file a return, but I get this credit. So it zeroes out at the individual level. It's all paid at the entity level. The entity then can deduct that tax. That tax deduction goes through that page 1 of the pass-through entity return, federal return. So that ordinary income line that flows through the K-1, that would be reduced by the tax payment. So that's the credit method and how it works. The income reduced method, same situation, an election is made, tax is imposed at the entity level, but instead of, when I file my tax return, having that income flow through and getting a credit for it, when I file my return, I would have a deduction of the income flowing through. So instead of a credit, I'd be able to deduct the income that was taxed at the entity level. Still gets you to the same spot, right? Whether you're deducting the income or taking a credit, at the individual, there's no additional tax having to be paid. And oftentimes, under the income reduced method, the owner doesn't actually have to file a return in a state where they're not a resident unless they have other income from sources within that state. So that kind of acts as almost like a composite filing as well. So those are the general mechanics. Generally the states are going to follow one of those two methods. And then we'll definitely dig into a lot more detail from here. But if you have this framework kind of in your mind, election, we can impose tax at the pass-through entity level where the income's going to flow through to the individual, but you're either going to get a credit for the tax paid at the entity level, or you're going to get a deduction from the deduction of income at the individual level. And so the states, what's really important to note is the states are revenue neutral. So the states are very open to enacting legislation like this because it's revenue neutral, and they are assisting their residents of the state in obtaining a federal tax benefit and really putting them on par with their tax position prior to the Tax Cuts and Jobs Act. You probably have heard some political strife with regard to the SALT cap and even new legislation, and Democrats saying we're not going to be on board with any new legislation unless the SALT cap is repealed. That did not happen. But, is the SALT cap really going to have to be repealed if we have all these workarounds? Because the federal government isn't going to get the revenue from this if a lot of states are doing this. And, does it need to be repealed, if that happens? And I will say that New York and California were two of the states that were front runners in this as well, because as you can imagine, high tax rate states. They felt that Republicans were targeting their state to punish them through that Tax Cuts and Jobs Act, just punish them politically. So they were looking very hard for workarounds. So a lot of interesting, I love, I've been working in state and local tax, I'm practicing in my 37th year now. And I love when I turn on the news and I actually see a topic of like what I work in. Hey, this is my field and it's on the news tonight. So it makes our jobs look, or at least be perceived as maybe a little more interesting. So we'll go to the next slide. All right, so polling question number 2. We just wanted to get a sense for the remainder, what size companies that we're speaking to. We might be able to revise kind of maybe some of the things that we're reviewing. For a size of company or firm, are you less than $1 million of revenue, 1 million to 10 million of revenue, 10 to 50, 50 to 100, or over 100 million? Just get a sense of size. Certainly the larger the firm and the more profitable. So the larger you are and the more profitable you are, obviously these pass-through entity elections can be very powerful. And in fact, if you are selling your business, right, and you're going to have a huge amount of gain from hopefully selling your business, maybe to a private equity firm, that you can, if you layer in these pass-through entity tax elections, they could be quite powerful. Okay, so I will wait for that polling. Okay, there we go. Okay, good. So we have a good spread. I'm really glad to see it's a very good spread. Okay, so I think we'll have a lot of good things to say, really, that will touch on everybody. So, okay, great. Let's go to the next slide. Okay, so I am going to turn it over to Tony, and Tony can go through some of the examples, and I'll pipe in now and then as I have opinions as well. Thanks, Tony.
Thank you, Kathy, and thank you everyone for joining us here today. I'm going to take you through 2 examples, and they will be for each of the different methodologies that Kathy had discussed just a few slides ago. Starting out, we're going to go with a credit method state. So Maryland chose this one. It's been around for almost now 2 tax filing seasons. So it may be one that some of you have gotten some familiarity with already. But it's just a good example of without too many wrinkles in here. It's just a pretty straightforward credit method state. In the middle column, scenario 1, this would just be a situation of a owner of a pass-through entity and be receiving, we put a nice high number here to really show the savings. 10 million in ordinary income from a K1 from the pass-through entity. Going through on their individual return, just using the highest individual tax rate to keep things simple here. They would have a 3.7 million federal income tax expense. As a Maryland resident, we would go down, they would be subject to state income tax at 8% and pay 800,000 in income tax to Maryland. In situation 2 or scenario 2, this is where we're going to be making the election for Maryland. So as we go through here, the entity, you can see their federal income tax will be reduced. So the amount that they would be receiving on their K1 and ordinary income would be reduced by that amount of Maryland income tax paid by the entity at the entity level. And so here you have 9.2 million of ordinary income subject to federal income tax, and you bring down that federal income tax expense by 300,000 or so to have a nice tax savings here. As Kathy mentioned, for a lot of states, it's the thing is for them, it's going to be revenue neutral. So why you'll see so many states have really been enacting legislation for these is for them, it really isn't going to shift the amount of state income tax that is paid in most situations, rather just who's cutting the check and where it's being paid. If the entity does it, it's being paid, run it through the entity, then it's deductible. So in this situation here, the individual on their Maryland income tax return, they're still going to be reporting that amount of income on their Maryland return, and they're going to be computing the tax. So this is the key point here for a credit method state, is you're still going to be actually computing the amount of income tax on that individual's return, but they're going to be offsetting it by that amount of credit that they received from the entity. So in the next slide, we'll see and compare it to an income reduced method state. The end result is still that, the individual would still have no remaining tax due in these examples where there's no other sources of income from the state or anything like that. So just a different way of getting to essentially the same result. You'll see here, okay, they paid the same thing, same amount of Maryland income tax. It's just that federal income tax has been reduced there. So just changing who pays it. Wisconsin, this is an example of another income reduced method state. Another one that has been around. Wisconsin was one of the first adopters, 2018 for S corps and 2019 for partnerships. So one that some of you may have already seen because it's just been around for a few more years than some of the ones that have just been enacted, in the last year or so. But same amount of federal ordinary income coming from the pass-through entity, same federal income tax expense for them. This is an interesting one because Wisconsin has a different tax rate here on the pass-through entity tax as opposed to the individual's tax rate. So this is an example. Not too many states really do this. Typically, they're just going to pick the highest applicable individual rate. Wisconsin is one, is they impose the corporate income tax rate as opposed to the individual rate for the pass-through entity tax. But here in this situation, the individual, their Wisconsin return is going to report that amount of income, apply the Wisconsin individual rate, and pay $765,000 in income tax to Wisconsin. In the situation where they are making the election, same thing, the pass-through entity pays the tax at the entity level. They take the deduction on the pass-through entity's federal return. The share of ordinary income is reduced by taking that deduction for the state income taxes paid. Here in this situation, the individual ends up paying a lesser amount of federal income tax by way of that deduction, or just having a lower amount of ordinary income coming from the pass-through entity. On their individual return, now we're kind of illustrating how this income reduced method comes into play. So here, that individual on the Wisconsin return, as a resident, they would be starting out with their income from all sources, their AGI, just like most states do. But instead of computing the tax and having a credit to offset, here would be the situation where they just would be allowed a subtraction modification or deduct the amount of income that had already been subject to tax at the entity level. So in this situation here, there's just no taxable income to compute any tax on, as opposed to Maryland, where you're still computing the tax but offsetting with a credit in a credit method state. At the end of the day, it's still the same result. Really, is just is there any tax being paid left over? No. In these very pure examples where there's no other sources of income or anything like that. But that's really just the key difference in the mechanics when it comes down, for the individual and their filing. A little bit of a distinction there, but functionally, if the tax has been paid at the entity level, it's really just shifting who pays it, and not much of a difference for the individual. They're like, hey, do I have to cut a check at the end of this? Well, no. Now, we're going to take a look from the background that we discussed to 2022, the current day, and where are we now with pass-through entity elections. So when the IRS issued Notice 2020-75, almost 2 years ago now, we had 7 states who had enacted some kind of elective pass-through entity tax in response to the SALT cap. Since then, and since that has been released, we are now, I'll say, 30 jurisdictions, 29 states, and New York City was just recently the first city to enact a pass-through entity tax. So we're up to 30 at this point. So a big number once the IRS issued that, to kind of, maybe not necessarily a blessing, but to kind of give some kind of reassurance and acquiescence to these regimes that, at least for now, taxpayers can follow that guidance, and they can take that deduction at the federal level for the state income taxes paid by the pass-through entity at the entity level.
And Tony, I would say that honestly, this flurry of legislation in this past year or two, these are some of the biggest changes at the state level that we've seen on a multi-state basis since Wayfair, you know, in 2018.
Absolutely. It's not often you get that many states to kind
No.
of do something similar, especially in a short amount of time.
Yeah, we'd like to say similar, but unfortunately they're all different. And once we get into more slides, there's so many different nuances to the different states. Unfortunately, really wanted the states to adopt a uniform model, but every state had to tear it apart for their own jurisdiction. So,
Yeah.
but anyway, I would say this is just very monumental in the state tax world with regard to changes.
I would say maybe only second to Wayfair in terms of how many states and how fast. I think a lot of states were, just waiting on standby for Wayfair and just had the legislation like already ready to go and, to introduce as soon as that ruling came out as they had planned. So as of right now, there's 3 additional states that have introduced some legislation to enact their own pass-through entity taxes, Iowa, Pennsylvania, and Vermont. They haven't exactly been moving along too quickly. However, the legislation is out there. So at this point, of states that have an income tax, that puts us at really, by my count, 10 states that really have not either enacted or at least introduced some legislation for a pass-through entity tax. So really winding down there. Here we have a list of the states or the jurisdictions that have enacted their own PTE taxes in response to the Tax Cuts and Jobs Act. Connecticut still remains the only mandatory one here. Colorado and Virginia, we'll discuss a little bit later on in the presentation. They are 2 that recently have enacted some kind of retroactive legislation to go back and make that election and pay the tax at the entity level for, I guess 2021 hasn't passed just yet. I guess if you're extended, we're kind of winding down on time, but Colorado, especially 2018, I mean, these are filing seasons that are long since passed. And now New York City too, being the first city here. But you can definitely see that the majority here are that 2021 and 2022 when these elections are first applicable. That brings us to our 3rd polling question. Which one of the following statements best describes your relationship with Cherry Bekaert? Cherry Bekaert is our current income tax service provider. B, Cherry Bekaert has assisted us with some projects, but is not our current income tax provider. Or C, we have no experience working with Cherry Bekaert, but looking forward to opportunities to save on taxes.
Yeah, so Tony, we're giving people real easy questions. So when we've done CPE before, we've given you a very technical question based on what we just discussed to see if you could answer it. So we're giving you some.
Who's paying attention? Yeah.
Yeah, so these are some easy ones to get your CPE. So not that anyone has to answer them correctly, even in the difficult circumstance. Okay. Did we get that polling?
Anxiously waiting the results.
Yeah, is that gonna, let's see. Oh, there it is. Okay, good.
Also,
yeah, a lot of it's evenly split. Yeah. Okay.
All right. I've selected a handful of states here just to kind of illustrate some of the similarities and some of the differences. I have first off 2 credit method states, which would be I've got California and Maryland, and then next to income reduced method states, Georgia and North Carolina. So California, an election that was first available for 2021. Elections made every year. It's not a situation where you're locked into an election for multiple years, or just that it's in place until you specifically want to revoke that election. But once it's made, it's going to be binding for the tax year. California is interesting in that owners have the option to separately opt in or opt out of the election, as opposed to it being an election binding on all of the owners of that entity. So California was the only state that was taking this approach of allowing the individual opting in or opting out. Arizona, which is a state for 2022, it's first available, a state that they follow California fairly similarly in their legislation that they enacted, and they're the other one that I'm aware of that allows that individual opting in or opting out. But for the most part, the majority approach that states have taken is that the entity makes the election, it applies to everybody, or at least all of the owners of the entity that are subject to personal income tax, individuals, trusts, estates, and they carve out, other pass-through entities or C Corp owners. California, it's a rate of 9.3%. California has taken the approach that for non-residents, it's a different approach for whether it's apportioned or non-apportioned income. So for non-residents, just like other states, they can only impose source income of non-residents. So it's on apportioned California source income for non-residents. However, for California residents, the base of income that the tax is imposed on is their entire unapportioned distributive share of income from the pass-through entities. So it's a larger amount of income subject to the tax. It's more tax that's paid at the entity level, but in the end, it creates a bigger deduction for federal purposes as well.
Yeah, and Tony, that provides kind of a disparity right now, really, because you have residents and non-residents being kind of treated differently. So a resident in the pass-through entity tax base is the whole K1, but the non-resident is just the apportioned. If you have an S Corp, you're going to have to be careful of distributions, that you're not creating, unequal distributions. You might have to have some true ups to equalize that. And also another problem that causes, per the partnership, like in a partnership agreement context, can you specifically allocate that deduction to the resident partner who got this big deduction? Because the non-residents are only having an apportioned amount, so they should have a smaller deduction. But you're talking about that line one ordinary income that many partnership agreements is just based on profit percentage. Split by partners. So you would just, if you own 10% of the partnership, you get 10% of that ordinary income. Well, what if you were a resident and your tax base for this pass-through entity tax was a lot higher than a non-resident? If the partnership agreement doesn't allow for specific allocation of expenses to specific partners, that California partner may not get as much benefit as kind of intended or is seen on the face of this. They might not get as much benefit, but they are benefiting the other partners that are non-residents. It's like, hey, they should.
I can't complain. Yeah,
those non-residents should take that California partner out to dinner or something. So you have to, you have to kind of look at, okay, what does this mean in the concept or in the just in regular partnership and S Corp taxation? And does it cause any issues? Do we have to look at our partnership agreement? And also, even, I guess I'll just say here, we might have something out later, but we have to make sure that your partnership agreement is clear on who gets to make elections. In some states, it has to be like owners, all owners have to agree, or is someone authorized to make the election for all the owners? So you have to look at the partnership agreement to make sure that you have an understanding, in which we probably will touch base further. You could have people harmed by this. So far we've been saying, oh, all this good news, it's all going to be deductible. But in certain circumstances, you could actually have owners harmed by this election as well. So go ahead, Tony, sorry.
California, another issue that they were kind of unique for at least 2021 was that the credit that the owner receives from the entity is a non-refundable credit. It is given a 5-year carry forward, though, to use. But at the end of 5 years, if that credit isn't used, it does expire worthless. Arizona is the other state. Again, it's one that their legislation is very, very similar to what California enacted. So they would be now the other one for 2022 is taking that approach. Most states that are credit method states to begin with haven't taken that approach. So it didn't really, legislation that followed, states, that wasn't really anything that really took off all that much, but it has, especially as we'll discuss later on in the context of if you have Virginia residents, especially, we'll talk about a situation there where this can cause some additional layers of confusion, or we'll say planning opportunities here. California, they made, again, a very complicated, I think, election regime. And so far, they've just now passed 2 pieces of legislation for technical corrections, because as it's out there, and people are starting to understand it more. It's like, well, there's actually some issues here that we need to fix, because otherwise it would kind of just, got the whole benefit of taking the election, or maybe even be in a worse situation. So starting with 2022, California has enacted another piece of legislation to adjust when that PT credit is claimed, either before or after the past serenity credit. So for 2022, the PT credit will be last. It's claimed after the credit for taxes paid to other states. And so this piece of legislation, Senate Bill 851, that was passed last month, was another technical correction, because there was an issue that came out from the first technical corrections bill that was passed in February this year, that when you computed the credit for taxes paid to other states, what they called the net tax was an amount of tax that was already reduced by the past serenity credit. So when you would look at the same amount of income being taxed in both states, the credit would be the lesser of those two. Well, if the California amount is almost entirely wiped out by the past serenity credit, there's probably not going to be, in most situations, a credit for taxes paid to other states. So, it's not really keeping with the intent of the legislation of benefiting taxpayers if, you're harmed, especially by that. So this
Yeah, and
really
Tony, that's a good example. Sorry to interrupt, but that's a really good example of just how difficult this can get when you get into the details of it. So when you're just looking at ordering of credits, you could lose the benefit of your other state credits that you had. And so that's why this legislation was put in effect, to fix that. And it's so important in California, especially because the PTE credit's non-refundable. So that's very unique that it's non-refundable. So you want to keep an eye on that. Am I going to be able to use that in the next 5 years? If I can't use that in the next 5 years, I may not want to elect in to the past year entity tax regime in a future year so that I could use up those credits. And the elections, just FYI, elections are different in every state. The time frame of making them is different. There are some states, just although very few, that you lock in to it for a little bit, or some are just annual. So every component that we're talking about can vary by state.
One pain point, unfortunately, for the California election is for non-residents, the 7% withholding requirement, unfortunately, still applies. So keep that in mind.
That's crazy.
For just about everywhere else, I mean, the election kind of takes the place of withholding, or the entity is relieved of the requirement.
I'm surprised they did not correct that with the technical corrections, to be honest. They should have. But California's withholding, though, is different than other states in that it's imposed on distributions, not necessarily distributable income. So that might be why they didn't do it. But that could be a big cash outlay then. If
I think they just wanted more money sooner,
Get interest? I don't know.
Non-residents still have to file a California return. They're not relieved of a requirement. One thing to note is that the PTE credit can't be claimed on a composite return. So for owners, unfortunately, California didn't just prohibit composite returns. So, it's a bit of a trap there. Just be very aware. That's a very bad situation if you're going to pay California's very high composite tax rate and then also not be able to claim your credit. So
yeah, so if you have 100 partners and it's not that much benefit per 100 partner, remember that if you have 100 partners, if you do not make the election, you can file composite. If you do make the election, all 100 partners have to file a non-resident return in California. So you have to bake in kind of that compliance cost. Yeah.
Exactly. We're saving money, but didn't mean
Yeah.
it would be free, right? Some situations. Maryland, to compare here, it's another credit method state, and we walked through the example earlier. So I'll just kind of go over some of the highlights here of it, because also some of you may have just been more familiar with it because it's been out for longer than most of the other states that have gone for or go active in 2021 or 22. But Maryland, they came out with a new form 511 for electing entities as opposed to the 510 for pass-through entities who aren't making the election. It's binding upon all the owners for the tax year, so it's not one of the individual opt-in or opt-out kind of states. Partnerships, S corps are eligible entities, and here there's no restrictions to elect based on who the owners of the pass-through entity are. So the election's made, it's binding on all owners, the tax is computed on all of the income of the partnership of the PTE. And so you could have situations where, you have a partnership with C Corp partners, doesn't matter. Maryland, there's no restrictions on the election based on who the owners of the PTE are. They can beat the tax and start passing the credit up. As opposed to some other states where maybe they would carve out other pass-through entities or other entity type owners. Nope, Maryland, no restrictions there computed on all the owners. Maryland is another state where compared to California here, it's a Maryland apportioned income for residents and non-residents. Doesn't matter. Everybody, it's Maryland apportioned income. Maryland also has a different tax rate depending on whether you have anybody subject to personal income tax in Maryland, individuals, fiduciaries, and entity owners would be subject to the C Corp rate of 8.25%. Owners receive a refundable credit. So Maryland, again, this is a situation where you take the credit from the PTE, and if there's extra left over, you get a refund of it, as most states that are credit method states do. Electing entities are relieved of the requirement to have to withhold on non-residents in comparison to California. But however, they are prohibited from filing composite returns. So if you've got a situation with a lot of non-residents and maybe they've been used to participating in a composite return, it is going to change that because Maryland just outright prohibits. You can either elect or you can be a non-electing entity and file a composite return, but you can't be both. So what that means is, there's still a filing requirement for individuals. If they used to participate in a composite, they can't do that anymore. And to be able to do the election, it's just now they might have to get used to the idea of filing non-resident returns on their own for Maryland, where they didn't before. Georgia is a first income reduced method state. It is first available for 2022, made every year, binding on all the owners for the tax year. There's no individual opt-in or opt-out. Georgia has a pretty strict ownership requirement. So some language and legislation that's been trending, or you kind of start to see used more and more, is to just kind of shortcut ownership requirements. They just say any eligible S Corp owner. So for S Corp, if the electing entity is an S Corp, obviously that would apply for federal purposes. But in the context of partnerships, they just say if they could be an S Corp shareholder, then for a partnership, that's an entity that would be eligible to elect here. It's anyone that's 100% owned by those individuals and very narrow subset of trusts. So Georgia, if you could be a situation of a partnership with a C Corp owner, a 1% owner, the whole entity can't make the election. It's a bust. The rate is 5.75% on Georgia apportioned income for both residents and non-residents. So similar to Maryland here, and where you can see whether it's a credit method state or an income reduced method state. Some similarities here. A lot of these situations here, the states are very different, but it's a lot of this or that situations, which we're used to in state tax, right? Are they a market-based state or cost of apportionment state? You have two options here. There's not really like these third options out here. So a lot of these, elections, there's some ones, outliers that are doing one or two things on their own, but a lot of situations, it's just a combination of all these different things. I still don't know if there's two that are like carbon copies of each other yet. I think Arizona and California come pretty close, about as close as I've really seen out in the wild. So Georgia is an income reduced method state. Owners will file their own Georgia return and take a subtraction for the amount of income subject to tax at the entity level. So for residents, that's the thing, they're only going to have that Georgia portion amount. So that's the only amount of subtraction otherwise that they would get. So it's just going to be a smaller amount in situations of income that can be taxed at the entity level and ultimately take the deduction and produce federal taxable income. Electing entities are relieved of the withholding requirement on non-residents, and non-residents are not required to file a Georgia return if their only source of income is from one or more electing pass-through entities. So, this is a situation here where the non-residents, if the entity makes the election and assuming they don't have any other sources of state income, are now relieved of that requirement to file a Georgia return. So they don't have to file separately, and this could be a situation where maybe they're used to having to file a composite return, or really in practice your preparer would have to produce the entity return and the composite, really like the Georgia return was 2 returns. Here's a situation where you would reduce, on the other end, reduce the amount of compliance by taking the election.
Hey, Tony, for North Carolina, everyone will get the slides, so we can let them read through that because I want to make sure we have enough time because we're really running short. So that we could get to the other considerations. So Tony had gone through 3 states in detail. These make the same points, kind of go through. You could read those on your own. And let's keep moving forward then, Tony.
Okay. Yes, poll question number 4. How did you hear about this webinar? An email from Cherry Bekaert, social media post, Cherry Bekaert professional or alumni, or a friend or colleague.
And this will be helpful information for our marketing group to know how people got connected with us. And I guess I'll take this moment here, Tony, to say also just overall with these elections, you have to make sure you get the payments at the right in the right place. If you're making a pass-through entity tax election, the payments have to be made by the pass-through entity, not the individual. So if you're looking at making elections for 2022 and you had individual owners already make estimated tax payments, generally, you are not going to be able to get those estimated tax payments moved over to the entity. They're going to have to be made at the entity level again. And then once the return is filed, the individual will get a refund of their estimated tax payments. So that could, be a cash flow kind of issue temporarily, but you have to make sure the right person is actually paying the tax.
That's right. And it's just a situation you see very often here for a lot of states, and just a first year of taking an election, is that there will unfortunately be some duplication of payments. Hopefully plan early and avoid that as much as possible. But
okay, they're not going to show the polling. Keep going, Tony, and we'll want to make sure we hit the highlights on this so that we can cover everything.
Sure. We have resident owners here, just kind of showing, to recap some of the states that we went in earlier, that for credit or income reduced method states, in this situation that, it one way or the other. Credit method states could be the resident's full or apportioned share. Same thing with income reduced method states. So just one thing that, keep in mind that, regardless of the method used, it doesn't necessarily indicate if they're apportioned or non-apportioned states for residents.
Yeah, and so for retirement income, this is one that is interesting and comes up. There are deferred compensation retirement type income plans where former partners will get a K1 with a guaranteed payment. It's really a retirement payment. And so only a couple of states have really spoke to this. Unfortunately, we're in the same situation with the states not providing a lot of guidance on every issue. But Georgia and New York have issued guidance that any retirement type income that's showing up on that K1 is not in the pass-through entity tax base. And that's because that federal overriding legislation that retirement income is only taxed in the resident state. So they're just carving it out of that pass-through entity tax base.
As mentioned earlier, we have 2 states that have enacted some kind of retroactive provisions to make the elections. Colorado is a state that had passed first in 2021 its own regime for a pass-through entity tax that would go live in 2022. But this year they enacted a piece of legislation, being really the first state to really start to look back for tax years that are, already been filed and already been closed. But still open statute of limitations to be able to make the election going back retroactively. Probably for these two states, I guess we'll have to have a sequel to this webinar to go through, because as it was written, much we can do about it right now. You won't be able to make the election, what is it, until 9/1/2023. So we've got a little time on our hands to figure out what to do. And so does the DOR. We're, kind of taking a wait and see approach at the time on these, because other than the legislation, there's really not a whole lot out there as far as guidance goes of forms and the mechanics of how it will be done.
We're always hoping that states would become more uniform and simpler and reduce compliance. This is not the case here.
No, it's a piece of legislation that sold really well. We want to help Colorado and Virginia taxpayers here. We grant the DOR the authority to, effectuate the intent of this legislation, and knock yourselves out. You guys figure out how to do it. There you go.
Yeah, so Virginia the same way, right? For 2021, the election applies, but we don't even have any guidance yet.
Nope.
And hopefully we get guidance by the extension date of 2022 so that we can make the election on the 2022 return. We should have guidance for that. But not until like October or so of next year can we actually take a pass-through entity election on 2021. So you're talking about, amended tax returns, which is, talk about complexity. And I can see there was somebody probably that had a lot of influence in these states that had a lot of taxable income in these years, and they were able to get the legislature to make this retroactive. So that's usually how complicated legislation comes into being.
Call them well lobbied for exceptions to the rule. Right?
Exactly.
That seems too particular, too specific. Like, yeah, somebody might have
Yeah, and we have no other guidance on Virginia. Like, it's just very bare bones legislation. So
it is a two-page piece of legislation.
Yeah. More info to come on Virginia.
Yeah. Right. The DOR just issued a notice and said, hang tight, everybody, it's coming. Yeah. So hopefully, I was hoping we'd have something to speak about more for Virginia for this webinar. Unfortunately, we don't. So maybe we just have to have that sequel. So reciprocity states, I kind of alluded to this earlier for California, Arizona, California, Virginia. I hate to leave, Oregon out in the cold here, of states that, we don't see it as much with our footprint, but, not to exclude them or anything. So these are states where there's a situation of they have reciprocity with each other where, normally a resident would claim credit for taxes paid to other states on their resident return. For these states, say a Virginia resident, they would claim for taxes paid to California, the credit for taxes paid to other states on their California non-resident income tax return. So, in the way that the credit for taxes paid to other states interacts with California's PTE tax credit, can kind of create a situation where, without some careful planning here, there could be a possibility of locking up some credits and, may not be able to use them all. Because if they're going to claim that credit first, then, their California income tax is going to be reduced by that, and it's going to reduce that amount of credit that they're going to be able to use. As a non-resident, it's only going to be their California apportioned income, so it's not like they have, their full base of income to be able to apply it against here.
Yeah, and that's a real complicated mechanism on how that works. So if you have California in these states, you just be aware that you have to look at that further.
Yep. And again, because it's a non-refundable credit, just an issue to keep in mind here. Also now for Arizona is, this is for 2022, we're going to be starting to see that one as we come into that filing season. But, generally, I mean, the biggest thing to have to consider here, the determination of whether, there's going to be a benefit to making the election, which we really hope, and in most cases should be. That's the whole intent of this. But, traps for the unwary, you could fall into. It's always, going to come down to usually the owner's state of residency is where, these issues, and without it taking them into consideration, can happen, just like in the case of, a Virginia and California resident, non-resident, making that election without thinking through these, these situations. It could be building up a huge amount of credit in a year where maybe there's a transaction or something, and an unusually high amount of income in California. And then what if they don't have very much California source income for the years afterwards? Those credits will be locked up and could possibly expire without being used.
And especially owners too, if you have like owners in multiple states and you have owners, especially in those states that have not enacted a credit or have not enacted a pass-through entity tax election, they may say, and this was a big issue in Virginia till Virginia just corrected this with Virginia and Maryland, but they may say that if the tax is paid at the entity level, you don't get a credit for it. So if you make an election in another state, pay tax at the entity level for that other state, you're okay, get credit in that other state. But if you have an owner in a state where you can't get a credit for the tax paid at entity level, you just doubled the tax for that owner. So you can actually increase and harm those owners. And that's where I say you have to be careful on these elections and who is able to make the election. What if you have a partnership where half the people would be very much benefited, half of the people would be very much harmed? You make an election, you could get a lawsuit by the ones that were harmed on, hey, were you authorized to make that election? You have to be careful on understanding whether is this overall beneficial or not to the owners.
Mm-hmm. And, one other issue, we didn't really see this trend very much, Connecticut being one of the first states to even pass an entity level tax in response to the TCJA. Maryland or Massachusetts has been the only other state since then to do this, but this is where their credit method states, the credit is not a dollar for dollar credit. The states are taking a little bit of a cut.
And that's a great way to raise taxes. You don't have to increase and you don't have to tax anything different. So if you think about it, I'm getting a credit, right, for the tax paid at the entity level, but now I'm only getting a 92% credit. Well, they just got more tax from me. If I reduce it to 80% credit, all they have to do is reduce the amount of credit applicable to raise their revenue base. It's a very easy way to raise revenue at the state level.
Mm-hmm. Connecticut at 87.5% right now is where
is
that
it? Oh, it's gone down. Ooh, yeah, since I last looked at it. Okay, so some last special issues and considerations. There is uncertainty at the federal level. This does sunset in 2025, right? So you only have those years. Will it be appealed at the federal level, the SALT cap? It's still very controversial, but now that it's not producing as much tax revenue, maybe they're not going to do anything about it, and people are benefited by these pass-through entity elections, so maybe it just goes till it dies. It'd be interesting on whether they renew that SALT cap, because again, this kind of eliminates a lot of that ability, at least in a business context, right? People could have taxes that are not coming from flow-through entities that would still be harmed. Timing of payments for federal deduction, you have to watch that. So the federal deduction, are you on cash or accrual method of accounting? If you're on an accrual method of accounting, can you deduct if you're not making the election until March? Right? So there's kind of an argument that no, the all events test really hasn't happened because you haven't even made the election to be taxed at the entity level yet. But if you make the election during the year or you're making payments at the entity level, maybe you can, right? That, okay, we can deduct it for accrual method taxpayer without having paid the tax in that year. I will say the IRS notice has some language that says the tax has to be paid. I won't say has to be, but there's language referring that the tax needs to be paid in the year to deduct it, which goes against kind of that recurring item federal test on whether it's deductible for an accrual basis taxpayer. So there's some confusion there on the timing of the federal deduction. So if you just make the payment, I guess I might have gotten confused myself in a couple comments I just said there, but at the end of the day, if you just make the actual payments before year end, it can be deducted in 2022. Right? So don't depend on the accrual method that we haven't paid it yet, but it's just accrued to be able to deduct it. You could be sure by making the payment before year end, then, whether you're cash or accrual, it's going to be deductible in the current year, because there's just confusion around whether the typical accrual method of accounting would work in that situation. And I think we did talk before about the potential special allocations. We brought that up already. Look at your partnership agreements? Is everyone going to be economically whole? Make sure you're not creating a second class of stock for S corporations. Make sure you're looking at all those. We're on the state tax side, but make sure you're looking at all the federal tax implications, that you're not running afoul of anything there. And we have our last polling question right at 12 o'clock. We did a great job at timing, at least here. Would you like to hear more about pass-through entity tax elections? Yes, no, maybe in the future, kind of uncertain. I don't really care right now, but maybe in the future. And we're just so grateful that you took the time today to learn more about this. We've been in over our heads in this legislation for quite some time, and making sure that we're driving this value through to our client base. We're happy to help others if they're needing assistance with pass-through entity tax elections. Please remember too that if you are disqualified because of ownership, there may be some restructuring options that you could take advantage of to take advantage of pass-through entity elections. So instead of saying, oh, I have a C Corp owner, we can't do it, doesn't work for us. Well, maybe there's some other restructuring that you can do that will put you in a better situation so that you can take advantage of these elections. So we don't like hard nose right off the bat, right, Tony? We like to at least—
all hope may not be lost,
Yeah, all may not be lost. So we thank you so much for joining us today. We hope this was helpful. We'll probably do some additional webinars for sure with regard to SALT topics, but probably some follow-up in the pass-through entity tax election area as well. So thank you so much for joining us today, and have a great day.
Thank you, everyone.